beginning Pacific. America and the Court Sunday morning at a special Eastern. Ross Perot at 9 and About Books begins at 9 Eastern and Pacific.
Next, a discussion on the stock market 7, hosted by the Cato Institute. Barrie Wigmore, a limited investment brokerage firm at the Securities Markets in the 1980s, talks about the impact of the crash and what was learned from it. 1 hour.
Okay. Good afternoon. My name is Steve Moore. I'm Director of Fiscal Policy Studies here at the Cato Institute. I'm very pleased you were able to come to this lunch to discuss Barrie Wigmore, Securities Markets in the 1980s, which is hot off the presses, available at Barnes & Nobles and other bookstores, and we're Barrie here to discuss his book and the topic, the crash of for today. Let me tell you a little about Barrie Wigmore, and then I will turn it over to him to talk about the book. Barrie Wigmore is a retired partner of Goldman Sachs, and the only one that is still a partner. He was born in Canada in 1941 and educated there at University. He joined Goldman Sachs in 1970 and became a general partner in 1980. He retired in 1988 from his corporate finance activities for the utility, telecommunications, and he retired in investment in the firm and keeps an office there from which he conducts his personal business affairs. A well-received history of securities market depression called The Crash and Its Aftermath. It was published by Greenwood Press. I think you said it's available through the
Barnes & Noble on the internet. Only $500 a copy.
Only $500, well worth the investment. And of course his new book, again, Securities in the 1980s, which was published by Oxford Press. In addition to financial activities, in Washington politics, he has been active in Democratic Party, particularly with Senator Sam Nunn, Clinton, and the Democratic Leadership Council. He is trustee of the Progressive Policy Institute, Cato on some activities as well. Barrie Wigmore, please give him a nice warm welcome. Barrie.
Thank you. And thank you to the Cato Institute for Cato's done an excellent job of executing in policy areas related to the financial markets, and I'm pleased to be part of carrying that on. I'm also particularly pleased to see some old friends in the audience. Thank you very much for coming. I'm going to make a very point in this discussion, and that is government big impact on the stock market. And intuitively, true when you look at other countries like or Southeast Asia, and we are inclined to recognize it in our own country because the free enterprise system and competition are so entrenched here. It just happens in this country that the impact occurs in different ways, major. And Steve is going to some transparency up on the screen for me. Start by introducing a full stock market model, which simply shows how 500 would have moved at any point in the last 20 years if it moved exactly as much as interest rates. And you may say, well, what's special? Everybody knows earnings and interest rates are the basic for stock prices. And what's important is that I'm focusing on not reported earnings. These are available from the Institutional Brokers Estimate System, a rather neglected, in my opinion, which polls 9,000 analysts covering the S&P, and it aggregates all of their estimates for the current year and the next year, which are commonly called year 1 and year 2, and publishes the mean estimate for the S&P 500 earnings in the current year and the next year. And this graph shows you what those estimates look like early when President Reagan came in. And importantly, you can see a very great difference between, I got to get reversed here. Just a second. Very low recession of 82, 83. And you can see some very high estimated earnings a year ahead at the very. And if you look at you can see earning estimates looking ahead coming in are not very high, much above report. But as soon as he comes in, there is a jump in estimate. You can see in the next chart what the difference between reported earnings and estimate throughout the last 18 years. And you can see it's very low. Begin, but thereafter, the difference is 30, which shows you little relevance reported have to the stock market, and different relevance the projected earnings have. The whole psychology of anticipation changed dramatically under President Reagan. Projected earnings in 1992-3 far above currently reported earnings were high. That was because the Bush recession. And then more recently, you can see tend to be above 15% higher than currently reported earnings. Not something anybody would consider exaggerated. Now, if you give me the next slide, Steve. When we compare interest rates and projected earnings in the two-factor model indicated by the red line and compare with the average over the last 20 years, pretty closely for that big bump when the Fed rates so much trying to overcome the recession that the stock market simply ignored it. And then more recently, in 1997, when you can see the S&P 500 rates considerably ahead of the two-factor model. I'm going to talk about the effect on this graph. First, 1981, when President Reagan. Second, 1987, at the time of the current market environment. Steve had said I could talk about anything. I said, well, I'll talk about my book. He said, well, that's where the room's hard. Jump right to the current situation. Graph is up to date as of the S&P 500 at 925. Your Treasury at 515, and I took in the 1999, in other words, will be available, and I've assumed that, I think, pretty safe. On that basis, at the very end of the chart, you'll see the two-factor model has grown significantly with the S&P, and compared to the 25% over value 1997. On the next graph, I can show what the difference each month was between 100 and the model, expressed as the S&P 500, whether overvalued or undervalued. And I've truncated the undervalued because we're really focusing on the overvalued. You can see a big jump at the beginning of the 80s. Markets that Carter administration to overvalue more optimistic markets as soon as Reagan came in. In 1987, you can see a peak in overvaluation, which shows as about 27%, but on a daily basis, just before the crash, actually reached 30%. Recently, in the second half of 97, you can see that the overvaluation was around 25%, a high level. Without any polls that clerks and taxi drivers were in the stock market in 1990. It was a pretty optimistic period. So now what I'm going to do is take a look at each of these periods individually for a moment. Here's what we found in the two factors when President Reagan came into office. You can see relatively flat earnings projections until he's elected, and then 20% sudden boost in anticipated earnings. Stock market rose 10% the day after the elections in November. But despite that earnings are rising, you can see that interest rates were also rising at the same time, quite negative for the stock market. And the market basically ignored those interest rates, which was what created the overvalued situation we saw on the previous chart. Why did it ignore overvaluation? Because of Reagan's policies, which you'll see on the next chart. Wide array of financial policies very favorable to the stock market. We also lower taxes. Too little credit for its strong anti-inflationary support for monetary policy. During the 70s, monetary policy cared more than it did controlling inflation. And Paul Volcker, who now gets credit for changing, was actually in considerable repute by the end of 1980. He looked like he was much too politically motivated, much administration. And Reagan came in, and in the mid-1981 recession, that publicly and repeatedly that he wanted the Fed to tighten money, control inflation. He had a very simple attitude. There's too much money around. You want to get it down? The money supply, which is exactly what ended up being Fed policy years, and very successfully so. He also provided America with one of the most powerful tools it came to have in the broad restructuring effort that took place in the 1980s, namely replacement workers. He broke the public air traffic control strike in 1981 and also bankrupted the union replacement workers. An unprecedented move for any large organization in the last 2 decades. He also eliminated the carbon controls, took all the controls off the energy industry and took government out of the energy industry, and particularly eliminated oil price controls, putting on the right side of history, as someone else says, just at the time when oil prices were starting to decline. Very fortuitous move. But and also important, he turned antitrust regulation around 180 degrees, basically opening for a major merger, which became one of the key aspects of restructuring an efficient corporate American decade. And finally, He instituted a lot of financial deregulation, which most of you think of as savings and loan deregulation. Much more important regulation of the commercial banking sector, and particularly deposit rates, which were under regular restrictions prior to this. They were suddenly freed up. It turned into a very competitive industry, looking at high-rate loans against their high-rate deposits. And it was one of the key factors in leverage that took place and individual America in the rest of the decade. It ignored the overvaluation suggests because of these very Reagan, which I'm going to argue continued for 7 years, still the underpinning to the market. Now let's take a look at 1987 when for a moment it looked like things were going to come apart and these policies were changing. Here's what the two parameters in the model were doing as we approached the crash of October 1987. Earnings were rising earnings anticipated were rising very strongly, about 20% in 1987 and another 20% early in 1988, as you can see. But the red were also rising, unfavorable market. If you look and the stock market basically ignored interest rates, which is what produced the 30% overvaluation, which we saw in an earlier chart. The next chart, Steve. What was producing this overvaluation? Why did the market ignore the rising interest rates? Well, two simple reasons. From 50 billion in 1983 to almost 250 billion just before the crash in 1987. And the next slide, and the second reason it is the market ignored overvaluation, growth. Mutual fund purchases of common stock $8 billion in 1985 to just before 1987. But as we all know, these overvalued itself came apart in 1987. And it came apart and policies changed. Major policies changed in the right in front of the crash. The first important policy change was interest rates. A newly installed Federal Chairman, Alan Greenspan, concerned that the economy was pushing inflation again, made it extremely clear right in front of the crash that the Fed was going to raise interest rates dramatically until it slowed the economy. The second major policy change was the House Ways and Means Committee, which would have virtually killed the merger by eliminating unfriendly tender offers and by eliminating the high leverage transactions. And the third policy change was that Secretary Baker got in a very public dispute. The German finance department angered because the economy enough just a democratically inspired restrictive trade bill, let the dollar fall, didn't do something to stimulate. But all three of these things happened in the same week. We got a rush for exit. The Brady Commission blamed the resulting crash on the institutional holders of stocks, and particularly portfolio insurance. In point of the biggest sellers in the stock market, the biggest seller was the man in the street. And for those of you that wonder today whether mutual fund holders, Steve, let's show them the next chart. red bars here, mutual fund redemptions on a monthly basis, around on a daily basis, around 200 million a day prior to the crash. On October 16th, the Friday before the crash, 1.8 billion stock funds, and on the day of the crash, 2.6 billion. An unprecedented rush for the doors in mutual funds. A number of major mutual funds deferred their payouts 7 days. Most of them couldn't handle the volume of telephone calls came in. And if you combine these mutual fund redemptions with what small investors sold directly in the stock market, they were a larger source than institutions and portfolio in October the 19th. Now I'm going to move on to the present, crash that didn't happen. We had the stock market almost as overvalued as 1987, and here's, here are the parameters of the model as we come into the present, and you can see this is an earnings stock market with earnings estimates advancing each year, and interest rates being rather stable in the last 2 years. If any, would have to say that 1997 interest rates were declining. So both of the factors were favoring a rising stock market even faster than the factors would have indicated. And what was doing it? Same old friends. First of all, merger market. Mergers rose to a peak equal to 10% of GDP, $10 billion in 1997, roughly double of merger activity in 1987. And on the next chart, mutual funds. Mutual funds purchases of common stock in 1996 and 97, basically from the $100 billion level of the prior 3 years to about $200 billion. But keep in mind, matter of scale, the merger activity was an $800 billion demand for stocks versus this $200 billion demand. Why didn't things fall apart like they did in 1980? Very simple reason. There were no policy changes. There was no interest rate threat because inflation stayed low. The Fed was actually lowering interest rates rather than raising. The Clinton administration continued consumer-oriented panoply of products, much like the Republican administrations before it. Mergers continued totally unobstructed. That the restructuring in American corporate has, in particular cases, provided a lot of pain for sectors of the American, and the Clinton administration viewed a highly pro-business attitude, especially in the trade and high-tech sectors. So what happened with the passage of time is the overvaluation out. We are actually below the stock market level of August 1997. 6 months later, virtually a no-growth market for 6 months, but earnings projections have cut and interest rates have come down enough to justify the modest 8% overvaluation which we see in the stock market. If there had been a rush for the exits, like 1987, because of some things going wrong, it would have been very much like 1987. And 2 basic weak spots in the stock market would have been hit again, and the clearing system. The specialists collapsed for a very simple reason. The insurance say, rather than going to the block stock trading houses, which have 20 specialists and all the distribution power, were routed through the New York Stock Exchange's DOT system straight at the specialists. They don't use big one-sided principal risks. The other problem still exists today. We portfolio insurance as the potential seller, but we have a huge both in indexed managed pension funds and mutual funds, and now about $700 billion. If it became heavily one-sided sellers, it would go right at the specialists. We'd have the same problem. The other problem was the clearing system, which requires that banks advance to brokers secured credits, often just for a few hours, never for a day, in order to complete the clearing process. And if banks think at any time the brokers are going to go broke, that was in 1987 because the Fed strong-armed the banks in making advances to start the clearing system rolling. That problem would exist today if there was a serious question about. So what's leave you with two simple conclusions about the stock market today and in the last 20 years. The first is that this is not a period of new parameters. The stock market continues mean reverting to the two basic factors that determine stock prices: earnings and interest rates. We don't need alternative techniques for valuing the market. And secondly, the policies that the Reagan administration introduced in the early 1980s, which changed the whole atmosphere of the securities markets of the 1970s, the attractive securities markets of the 1980s and 90s, still remain in play. Those policies are a very anti-inflationary monetary policy focused on growth, strong consumer orientation in various government policies, tax cuts, a great deal of freedom to corporate America to restructure itself competitively in the market whenever it needs to, and in an orientation to free markets throughout the policy spectrum and the general economy. Unless we see those policy factors changing at some time in the future, I think we can all justifiably assume that the stock market is of your money. Thank you very much.
Thank you very much. I'm going to call my broker now. That was an excellent presentation. We want to open this up for some lively discussion. Anyone who has issue with anything that Barrie said or on any of the points he made, we want this to be a discussion. We have a microphone that will be passed around. If you have a question, please wait for the microphone to come. Please identify yourself when you ask your question. And we'll start. Any questions or comments? Stephen.
The Institute for Research on the Economics Section. Barrie, I was Stephen, Institute for Economic Taxation. Barrie, I was working at Treasury during the out-of-town. I want to commend you for bringing up the importance of the flap between the Treasury and the German authorities. I was appalled at the cavalier attitude toward the government at that time, and it certainly did contribute to the problem. Do you use earnings and interest rates in your model? Greenspan was nervous about the blip in inflation that hit the market. Crashing the dollar would tend to raise inflation expectations, and the Fed saw inflation expectations, and interest rates are driven in part by inflationary expectations. Is there a common thread here? When inflation goes up, it tends to erode the quality of the effect on depreciation right, and other factors. Expectations are trending down. You tend to see expectations that the future will be better quality. Use the 2-year Treasury rate in your model. There is some cap there of expectations a year or two out. What would the model look like, predictions be, if you used Treasury bills for future interest rates instead of 2-year Treasury rate? Are we in a situation now where part of it be due to the suspicion that not only low but may actually drop another point, whether it's due to the age or because the Fed has pursued good policies? And could capture it? Does the Treasury rate there capture it already? And is the decline in inflationary expectations that may be going on part of some of the strength of the market earlier in the last couple of quarters?
I basically see two questions in there, and the first one is, would this model look like if you used a different interest rate? In my book, at the back of chapter 3, I have an appendix, which is much more detailed than I suggested today, and it examines the results with interest rates all the way from Treasury to long-term bonds. Both short rates and long rates much correlation with stock price changes than 2 or 3 rates. The second question was whether inflationary anticipations are adequately captured in interest rates, and particularly the 2-year Treasury rate. And I go in, again, it's very interesting to look at the book, which covers the first half of the 80s. Because that period in time, we had a bigger between interest rates and inflation than we've probably seen any time since the Second World War. And as long as the Federal Reserve a aggressive anti-inflationary policy through interest rates, you tend to have a sharp disconnection between interest rates and inflation. They go on quite different paths. And the only time that we can really say that the securities markets follow inflation rather than was in the 1970s, when the Fed wasn't focused on controlling inflation and kept interest rates low to stimulate the economy, and the market discounted that.
Thank you. Jim Strodes, World Trade Magazine. You say in your presentation here that in 1987, stock purchases by mutual funds were the second largest valuation. I wonder if you now to 1997, talk about the foreign component, and then where you see foreign participation in the market today.
Yes, yeah, thank you, Jim. I actually forgot to mention that foreign purchasing was the same size as mutual fund purchases. Yes, in 1987. Foreign purchases in 1997 significant. Cohen, who is the managing director in charge of investment at Goldman Sachs, has made the point frequently, most recently on Wall Street Week, just this last Friday, that almost all foreign institutions are dramatically underweighted in the proportion of U.S. equities that they ought to hold on. probably by a factor of 10. And she suggests that is one of the major sources of power for the stock market in 1998.
They're coming.
One of have any money left.
One of the policy conclusions that came from the 1987 crash was the circuit breakers that were put in. And I'm wondering, are effective or wise?
Steve, I really don't have an opinion. I don't know how one tests it. I think the general feeling was in 7 that they were detrimental to market equilibrium, but I don't really have an opinion.
Yes, Barry, I read sorry, Ely and Company. Barry, I read your chapter for your forthcoming book, Revisiting the Crash of October 1987. Take issue with you over the role that you attribute to the Fed in one regard. Basically, you say that the Fed bludgeoned the banks into lending to possibly bankrupt securities firms, and I certainly on that point. But then you also suggest that the Federal Reserve flooded the markets, and that simply isn't true based on a reading of the Fed's own data. I'd like to come back to the first point in terms of what did, and specifically through the offices of Jerry Corrigan, the then president of the New York Fed. Essentially, the Fed went to the banks and said, we don't have any better idea than you do about whether or not securities firms and broker-dealers are solvent. We want you to lend additional money, and we want you to take extraordinary risk with your stockholders' capital. And by the way, if you run into a little bit of a problem, we'll be glad to lend to you on a basis that is riskless to the Fed and their taxpayer. Now that strikes representation, because if there had been losses on that lending, it's suffered loss, and the Fed would have been able to walk away from it, even though it was a driving force for that lending. But in terms of what the Fed applying liquidity to the markets, you simply don't see it in the data. There was a one-day on Wednesday the 21st in the amount of discount window lending, but the rest of that week and the following weeks, window lending was actually very normal or below normal levels. So the Fed didn't really do anything to speak of, except to twist arms to get these banks to take extraordinary risks for which they probably were undercompensated.
Well, I certainly agree that what the Fed did was twist the banks arms. When Jerry Corrigan called the head of Citibank and make clearing loans, John replied to him, "I can't take the risk of $1 million. My stockholders would lynch me, and they'd have every right to do so." He lent $2 billion on October 19th and did not take possession of the collateral. So the discussion obviously went on a little longer after those. The other thing the Fed did was significantly reduce interest rates, which is the liquidity factor that the market had its eye on. And interest rates dropped very sharply after that.
Questions?
Judy Burns, Dow Jones. What lesson, if anything, do you think that the individual mutual fund investor took from the that play out in the next market?
Well, mutual fund investors were very frightened by the crash. Now, I don't mean in front of the crash or during the crash. I mean after the crash. They were very frightened by it. Fund investors took money out of the stock market in aggregate in for the rest of 1988. I think the aggregate $18 billion number, and they were actually insignificant investors in 1980. So they stayed away after the.
Does it concern you that so many of the people in the market now have never experienced a crash? So there's. Do you agree with that?
Well, I said in 1997 that there was exuberance in the market. I was at a Goldman Sachs conference, which is for professional investors, a conference in New York in the spring of '97. Breakfast room where everybody had breakfast before the conference, and I was late, and everybody had left, and I was sitting on some orange juice, and all the waiters, the Wall Street journals that were left on the table, which I thought what was a sure sign of ignorance. Everybody knows that the public and over-optimistic during 1997. That's considerably. I think you could see in one of the graphs I showed you that inflows into mutual funds have actually declined, but they have declined. And I would, is a requirement of optimism or exuberance that it turn into a crash. It's just more likely that returns for a period of time aren't as high as I hoped they would be.
Wow.
Bob Levy, Cato Institute. Two quick questions. You suggest that now is a investing in the stock market, as has been the last few decades. And as one of your reasons for making that suggestion, you suggest that the Reagan policies remain in effect. Identified three: anti-inflation, tax cuts, merger freedom. If the Clinton administration has continued Reagan's tax cut philosophy, it must have missed that. And the Joe Klein Justice Department is simply the Reagan Justice Department perpetuated, then the press has certainly misreported what that Justice Department policies are. Now, it does two of the three factors you identified as being still in effect are quite different than what they were under the Reagan administration. That's my first question. Perhaps you could answer that first.
Well, I may have suggested the Clinton administration too narrowly, because counts is government, which is the interaction of Congress, the administration, you were saying that you didn't think the tax policies were well, we just did a tax cut, and in other ways we have a pretty oriented government, and I think the market is pretty secure between a Republican Congress and Clinton administration. There's no radical or significant change from that long-term trajectory. Quarrel with lots of the issues that forward by any part of the government, but the fact, I think, still on the same trajectory. And on the merger front, obviously, the net effect is on the same trajectory. Not as if the administration gave carte blanche to corporate America for mergers. Of mergers they protested, the bulk of them they allowed to go through, and that's true today.
A question about your two-factor model. You use 2-year treasuries and 2-year estimated earnings from IBEST. Now that's choosing from among a very large number of interest rates that you could have selected and a very large number of earnings estimates that you could have selected. Moreover, it excludes reported earnings and dividends and payout ratios and debt equity ratios and variability of dividends, variability of earnings, all of which variables are forecasters. It wasn't you came up with this because you determined it had predictive significance, in which case we could look and identify the points at which it indicated an overvalued market, could have bought and sold indicators and made lots of time in the market. Was it that this is the way things ought to be? My theoretical proxy for how prices to establish. I can go back and find that weren't established that way and see the variables like the rate that account for differences.
Pick the model not because it's what I want, but because I would observe that's in fact what people do. The commissioners in the securities markets focus not always dramatically on projected. That's the 30,000 security analysts who are the principal carriers of to the rest of the world. They focus on earnings like nothing else. Executive, what he thinks the stock market is on, and he will give you earnings results. And the interest rates are the obvious factor. I mean, it's itemized every day in all financial press as the impact on the stock market. And theoretically, we know that the stock market has some kind of cash flow in the future using interest rates. Use 2-year interest rates because they happen to match the 2-year estimate. I use 2-year earnings estimate. In fact, a rational market would look as earnings are available. And 2-year IBA's earnings estimate only statistically robust earnings estimate you can put your hands on. Other kinds of earnings estimates tend to come from various relations of strategists and forecasters compared to 9,000 analysts estimating for the S&P 500.
Can we make money? Can we make money using the overvalued and undervalued signals that are generated by your factor model? But if that's the case, suggesting that the market is 7% overvalued now, so why is it time to buy stocks?
I didn't say it was a time to buy stocks. You said it was a time to buy stocks. I said if broad governmental policies do not change in the future, broadly speaking, the stock market's the place to have your money. Different from saying now's the time to buy stocks.
Chuck Austin with Progressive Policy Institute. Barry, I want to pursue a little bit, if we could, this interplay between tax policy.
I can't hear you, sorry.
I want to pursue, if I could, a little bit the interplay between tax policy and the model you set up. I have this right, but I count at least 6 tax increases during this period. 80 gas tax, 83, 84, which particularly taxes, 86, which shifted the somewhat on taxes, 90, the increase in rates, and 3 increase in rates. Is your model suggesting that are higher taxes in combination with policies? In other words, do tax increases not matter?
Sure, taxes matter, but taxes are reflected. Earnings are an afterthought. Whatever the panoply of taxes changes is, it's what earnings that count. They get fully reflected in the market in the model through the earnings factor.
Let me ask you one issue about this, because one other big policy change that you didn't mention was a change in trade, where we have seen an opening up of markets in the 80s and continuing under Clinton. Has that been important?
Well, I think, Steve, the main way trade is through its impact on earnings. If it raises or lowers earnings, it matters to the stock market. If it doesn't raise or lower earnings, it doesn't matter to the stock market. We're not talking about the economy or talking about the stock market?
Alan Reynolds, Hudson Institute. I wrote a piece on the crash in October Wall Street Journal, and it pretty much says what yours says about the Ways and Means bill and about the threats of deflation. But I did put a little trade twist. The tensions were behind, and the Gephardt bill and all that was behind the flight from the fear of flight from the dollar, and that in turn. What I did not do is blame the Fed, and my reasoning for that, and I'm not reluctant to blame the Fed. There's plenty of times I've done that in the Journal and elsewhere. And the reason was the Fed didn't, observedly do much. Short-term interest rates, control, the funds rate was like 50 basis points higher than it was at the end of 96. And yet the bond market had really tanked, as you know, and the long bond went over. There is an alternative explanation. It's quite consistent with economic theory. And that was the market was expecting devaluation. And if you think a currency is going to fall, the bonds in that currency, a lot of people who may have been holding Asian bonds recently understand very well. Because in dollar terms, the base bonds, or even stocks for that matter, got hit really hard. So I think basically the message was the U.S. Didn't give a damn about the dollar, and it was extraordinarily dangerous for holding. It made it attractive for Americans to move into foreign securities, made it attractive to move out of U.S. securities. And when the sell signal was finally given by Jim Baker on a fateful weekend, people ran.
I would agree 100% that Jim Baker's efforts to win the dollar right in front of the crash was a factor in causing the crash. The expectation was that it would raise interest and raise inflation, encourage foreigners. The Fed did raise interest rates dramatically. You cited federal funds rates. Treasury rates rose from 6.25% to 8.5% in the period. And particularly, they rose after Greenspan was appointed in August '87. But more broadly, I'd like to point out how well the U.S. stock market did from 85 through the decade, when the dollar was weakening steadily and inexorably over a month. So devaluation, call it that, didn't harm the stock market for a
with the Heritage Foundation. You talked about changes and impact on the market. I guess an upside and a downside question. If our trade goes up because of the continued anemia in Europe and what's happening, do you think there will be a resuscitation of protectionism? And I suppose potential upside discussion of Social Security reform program that might happen.
Well, let's take the Social Security. It would have quite an impact. First stage of buying stocks, the impact may be a little negative afterwards. I think the trade deficit is a good thing to point out as a problem in our whole economic profile. The fortunate aspect of deficit are that it tends to be discounted in professional people's minds because growth in the rest of the world is rather. If you could adjust to similar growth levels, presumably that deficit would be nowhere near as large. The second aspect of it is the deficit is rather small relative to the size of our economy and our securities markets. Third aspect is foreigners put a lot of money, which almost get created as exports, almost as if we produce companies or real estate or other that show up as capital than in the trade deficit, and they really ought to be included, which would look a lot smaller than it is.
If I can follow up on that, I didn't ask the question thinking that the trade deficit was a problem. It doesn't. My concern was if the reported number goes up, and if the financial press makes it an issue and politics try to take advantage of the issue for, and you actually have some sort of would that be a problem?
Protectionism is obviously a major in looking at the economic outlook because we identify the Great Depression of the 30s as being highly related to trade protectionism. If we had real protectionism, I'm sure it would disequilibrate many aspects of the world financial markets. I personally don't think the pressures for protectionism are all that great. I don't think you can ever, but I think our public in general and remarkably tolerant of the personal disruptions that have resulted from high trade levels. I think it's a great risk.
Time for one or two more. Is there anyone who hasn't had a chance to ask that would like to ask one? All right, well, Bert, one last question for you. Make them quick, please. We want to get these last two questions in. Bert and Steve, and then we'll close this.
This is a follow-up on the previous question regarding Social Security. Assuming that we had a privatization of Social Security, as many in this room would advocate, do you see that a stabilizing or destabilizing factor for the stock market?
Oh, Bert, I don't really know. We have an example of something like that in the Quebec pension plan, I think, which has been in companies in the stock market for 20 years. I don't know it in detail, but I think they've had some rocky periods on the side of destabilization. It would really depend totally on how wisely it was handled. You just don't.
Last question.
Stephen, about the changes in taxes perhaps being up and being detrimental to the market over the period. They have, and there was a big tax increase on capital in the 1986 Act, which people may not have quite realized the extent of until a year later. I think it would have. Be careful not to assume that rising taxes haven't hurt the earnings. The earnings may have been driven up by something else, taxes by the negative, but swamped by something positive. But I tried to suggest earlier, the rate of inflation may be powerful enough to swamp increases of the recent years. And one should underestimate the power of a good monetary policy to promote growth by moving in the opposite direction of what one monetary policy should do to promote growth.
I agree.
Barry, I'd like, maybe we've got 2 minutes left, close this off by, since this is a policy audience, maybe just reviewing the 2 or 4 major policies that you think either stay in place or change to keep this market strong.
I don't think, frankly, that we're going to have large policy change. And I think it's acceptable. I don't feel I'm in a position of recommending government policies. I'm in the position of interpreting how the stock market reacts to the economy and what government does. We've been very fortunate that inflation has stayed as low as it has, and I mean, we've been very fortunate. We've that it stayed as low, because that's why low. The Fed wouldn't keep interest rates otherwise. I think it's fair to say the Fed was probably tending towards raising interest rates in the middle of 1997 because it thought was over exuberant and we were going to have wage stimulation. But that problem has receded because the problems in Southeast Asia, which are having their own dampening effect on both economic activity and people's anticipations. It's just very that a government is focused on inflation as it that remain focused on corporate to restructure in efficient ways to be maximally competitive in a very competitive world, and that it not try at any stage to introduce some sort of puritanical, draconian policies that take it away from a basically consumer economy.
Thank you, Barry. The book is Securities Markets, 1979 to 1984, Barry, Oxford Press. Thank you for coming, and now we'll have lunch. Help yourself. And we'll try to discuss, continue during lunch. Thank you.
Tomorrow, Republican National Committee's winter meeting starts in Indian Wells, California.